$37.50. This is the cost of a dinner you cannot afford. You are sitting in a dimly lit restaurant at 8:15 p.m., pretending to read the menu while calculating the balance in your checking account. The cashier terminal displays a green logo offering to split the bill into 4 interest-free payments. This is the first signal that something systemic is at work. Level 1 is the negative $2,000 net worth tier. At this level, you are not using buy now pay later for luxury fashion or gaming consoles. You are using it at the grocery store self-checkout to buy eggs, bread, and milk because your bank account has $12 until next Friday. The app splits the $60 grocery bill into 4 payments of $15 each. It feels like a lifeline, a temporary relief from the math that never stops running in your head. But the relief is temporary because next week another installment of $15 is automatically withdrawn from your account. If your account is empty, the bank charges you an overdraft fee of $35, while the BNPL provider hits you with an $8 late fee. This is how the system extracts wealth from the most vulnerable participants. There is no relationship here. There is a transaction. The first rule at negative net worth: you are not a consumer, you are the product being sold to merchants. The BNPL company charges the merchant a fee of 5 to 6% on every transaction. The merchant willingly pays this because they know that offering microloans increases the average basket size by 45%. You believe you are borrowing for free, but you are actually participating in a highly engineered ecosystem designed to extract profit from your cash flow deficit. When a payment of $15 fails because your paycheck was delayed by 12 hours, a late fee of $8 is automatically applied. The system does not wait for you to catch up. The algorithms are optimized to detect financial distress and adjust your credit limit down, reducing your safety net when you need it most. Something changes, but not dramatically. You move to level 2, the $0 net worth tier. At this level, you have stabilized your basic survival, but you are trapped in a cycle of lifestyle maintenance. This is what lifestyle inflation actually feels like. You see a pair of designer sneakers online for $200. You would never spend $200 at once, but the app tells you it is only $50 today. Your brain registers this $50 payment as the total cost of the item, bypassing the natural hesitation that comes with spending a large sum. The second rule, interest-free, is a psychological buffer designed to bypass the pain of paying. Neurological scans show that paying with cash activates the insula, the brain region associated with physical pain. BNPL technology is engineered to keep that part of your brain completely asleep. By the time you check out, you have bought the shoes, a matching jacket, and a phone case, spreading $400 of debt across 3 different platforms. The app sends you daily push notifications, offering personalized discounts and reminders that your next payment is due in 3 days. You tell yourself you will pay it off with your next paycheck, but your next paycheck is already spoken for by the payments you authorized 2 weeks ago. This is legal. This is normal. You are trading your future hours of labor for depreciating consumer goods that lose 90% of their value the moment they arrive at your door. The system has successfully turned your lack of savings into a stream of predictable, recurring revenue for venture-backed lending platforms. The shift. This is the Competence Plateau, which represents level 3 and a net worth of $15,000. You have built a modest emergency fund, and you feel like you are finally getting ahead of the system. Yet, your purchasing habits remain tethered to the convenience of the 4-payment structure. You stack 6 different BNPL plans simultaneously, convinced that as long as you pay no interest, you are beating the system. You use Afterpay for a new mattress, Klarna for kitchen appliances, and Affirm for a road trip weekend. The system knows one thing about you. It knows that your attention is a finite resource. The third rule: when credit is frictionless, spending rises by 30 to 40% automatically. You are earning 0.5% interest on your savings in a traditional bank account, while your future cash flow is being drained by micropayments. You are managing payments to Affirm, Klarna, and Afterpay like a corporate treasurer, tracking dates on a custom spreadsheet. But you are playing a game where the house always wins. A single missed notification or a failed auto debit triggers a late fee that instantly wipes out the interest you earned on your savings over the last 3 months. Neither is useful. You think you are financially literate because you avoid credit card interest, but you are still leaking capital through a dozen tiny holes. Your savings account remains flat because the money that should be compounding is constantly being redirected to cover past impulses. Level 4 is the $50,000 net worth tier. You are trying to make a major life transition, such as buying your first home or financing a car. You sit down with a mortgage underwriter at 10:30 a.m. to review your financial history. You expect a routine approval because your credit score is 720 and you have no credit card debt. But the underwriter looks at your bank statements and sees 47 individual transactions to BNPL services over the last 12 months. To the banking system, this pattern of micro-borrowing is a significant red flag. It suggests that you cannot manage your daily expenses without relying on short-term credit. The underwriting software automatically flags your profile as high risk, triggering a manual review of every pay stub and tax return. The mortgage is denied, or offered at an interest rate that is 1.5% higher than the prime rate. The fourth rule: debt stackers do not fail because of interest. They fail because of cash flow timing. Over the course of a 30-year mortgage, that extra 1.5% interest will cost you $84,000. The convenience of splitting a $200 sneaker purchase has compounded into a massive financial penalty. The banks do not care that you paid every installment on time. They care that you needed a loan to buy shoes. This is legal, this is normal. You enter level 5, the $100,000 net worth tier. You have finally broken free from the cycle of short-term debt and built a solid financial foundation. But as you look back at your journey, you begin to see the true opportunity cost of the BNPL trap. You realize that during the 5 years you spent using these services, you diverted thousands of dollars away from productive assets. If you had invested those monthly payments into an index fund yielding 8% annually, you would have accumulated an additional $24,000. The fifth rule, the ultimate cost of convenience, is the compounding interest you never had the capital to earn. The wealth gap in this country is not just maintained by high interest rates, it is driven by the speed at which capital is drained from the consumer. The BNPL system is a bridge that allows you to live a life you have not yet earned at the expense of the life you could have built. You look at the balance of your retirement account and realize how much further ahead you would be if you had simply waited. The rules become flexible for those who own assets, but they remain rigid for those who only own liabilities. The system rewards patience and punishes the desire for immediate gratification, with compound math working against you. You finally understand that real wealth is not about what you can buy today, but about what you choose not to buy. We return to the dinner, $37.50. Somewhere in Chicago right now, a younger version of you is sitting in a restaurant at 8:15 p.m. looking at the cashier terminal. They do not know yet what the journey costs, not in dollars. The machine doesn't ask if you're ready. It opens every morning, taking whoever shows up. The final click of the screen completes the transaction, and the future is sold for the present. The balance is $37.50. It always starts there. It always will.